Hey, it is 12 noon on Wednesday, which means it's time for this week's episode of Ask the Instructor. I'm John Christman. The show is brought to you by the Tampa School of Real Estate. Every Wednesday, we're live helping you understand the technical side of the real estate industry. And what we're talking about today is something extremely important if you ever want to be able to invest in property yourself or work with investors as a real estate professional, or at least be able to get these questions right on your exam, because this hits on all of those marks there. And we're talking today about cap rate. It's extremely important for real estate investment. Even look, if you're doing flips on properties, even if you're not buying property for rental property, you want to understand how a rental investor that may be purchasing your flipped property may view this property as a rental opportunity. Right now, we're in the highest in U.S. history of percentage of renters. So that means there's a lot of landlords out there, and you might want to get on the action. You might want to assist these investors in purchasing property. You need to understand cap rate inside and out. And that's what we're talking about today. Cap rate, also known as capitalization rates. We've got a great show for you today. I'm John Christman. You're watching Ask the Instructor. The show is brought to you by the Tampa School of Real Estate.
You are watching Ask the Instructor. Absorb the knowledge. Become the expert.
Hey, welcome back to this week's episode of Ask the Instructor. I'm John Christman. The show is brought to you by the Tampa School of Real Estate. Every Wednesday, 12 noon Eastern Time, we're live helping you understand these technical topics. And today we're talking about something extremely important if you're a real estate investor, if you're considering becoming a real estate investor, if you want to be able to work with real estate investors, you need to understand this concept of the cap rate. And not just understand what it is, but how to calculate it and how to manipulate these other numbers with the cap rate. So let's first start making some sense out of this here. Something you might remember from the course called the Irv Triangle, or the IRV Triangle. So Irv, IRV, which is I over R times V, is actually the full formula for that. If you're good with algebra, you don't have to remember to put that multiplication symbol in. If you don't know what I'm talking about, then put the multiplication symbol in. So the R in this here stands for cap rate. And so our capitalization rate, the way you work with this IRV triangle is you basically circle what you're looking for. We're looking for the capitalization rate. And that's going to be the income over the value. So the I is income, the V is the value. So just to give you a simple example of this here, let's say we've got $10,000 in net operating income. That's the type of income that the I is in this IRV triangle. You always use net operating income, not including any financing expenses if you're going to do standard capitalization rates. And then you just divide it out by the value of the property. So let's say the property is valued at $100,000. So our income was $10,000, our value was $100,000. That means our rate is going to be 0.10, or 10%, if we turn that into a percentage. So that's our capitalization rate, or our cap rate, as it's shortly called. And what that tells us, this rate of 10% tells us that if we spend the value of our property, if we invest $100,000 into this property, and this is assuming that we're doing this cash. So this is also sometimes called cash on cash return. That's basically what your cap rate is. That means that if we invest $100,000 and we get $10,000 back in our first year, we're getting 10% of our money back. So that's what the cap rate is. It's what return on investment. We could just call it a return, but somewhere along the line, investors came up with the term cap rate, and that's what it's been called. But really, it's just a return on your investment, considering that you paid cash for the property. So let's say we wanted a higher rate of return. we want a higher rate of return. Let's say we want a rate of return of 15%. Now, if this property, we pay $100,000 for it and we get $10,000 back, that means we get a 10% rate of return. So when we're looking at investment properties, we might look at this and say, okay, well, if we want to try to come up with a 15% cap rate, maybe we still can pay this value of $100,000. But now the question is, what does our income need to be? So the question is, what is income? Income is rate times value, what you're left over with. You circle what you're looking for, what's left over is your formula. Income is rate times value. So what income do we need to achieve if we want a 15% rate with a $100,000 value? So our income, 15%, 0.15 times 100,000, our income would have to be $15,000. And you can see how that makes sense there. If we invest $100,000 and we want to get 15% of that $100,000 back, that's what the $15,000 is right there. That's the income that we need to generate. So now, how is it that we can increase our net operating income from $10,000 to $15,000? There's a few ways you go about doing this, and this is where you start this inquiry. This is where you start this process of digging deeper into this to see, okay, this is the number we need to come up with. Now let's see if we can make that number. Let's see if that's possible to get $15,000 of net operating income. There's a few things you could do. You could raise the rents. If you raise the rents enough, let's see, we need about another. Let's say that we need $5,000 here, and we're going to assume everything else stays the same. So we need $5,000 additional that we're trying to collect. Currently, right now, the property advertised for sale, it's at a 10% cap rate. We're going to try to increase it to a 15% cap rate, and we're doing that by increasing the income by $5,000. Let's say that there are, we'll keep the number simple here, we'll say 5 units. So that means if there's 5 units, we need to increase the rent for the year. Remember, we're all dealing with annual numbers for this. Income, we always assume we're dealing with annual numbers, and we want to be working with annual numbers. So for the year, we need an extra $1,000 per unit, which means how much is it that we have to raise the rents? Well, you know, if you've got different size properties, different size units in the property, you want to be maybe proportional with that. Maybe you don't. You know, there's no rules here. You do what you want to do. But let's say if we want to keep this the same across all units and just have $1,000 per unit that we're going to raise this for the year, which means for the month, we've got to raise the rent $83. About $84 if we want to round up and be safe to make sure we're going to get that $15,000. We're not asking for anything too crazy. I mean, the lowest raise in rent is probably like $50, so we're just really going one step above the lowest raise that usually ever gets done on rent. A lot of times rents get raised at a much faster rate than this, not just by $83. So if we divide that again by 12, we get $83.33. So we raise the rent for this unit by $83 a month. That's going to get us an extra $5,000 a year, assuming that we have this rented 100% of the time, assuming that we don't have any increase in cost due to any of this stuff. So is it going to be that simple? No. But this is how we start to make sense out of this. Maybe we have to raise the rents $100, but we're still within reason here. Maybe we're not. It depends on the property. You've got to look at the property. You've got to look at the market. If the property is already 50% vacant with the rents as they are now generating the $10,000, it's a lot less likely that you're going to be able to raise the rents. Maybe you still can, but that's what this whole inquiry is all about here. Now, let's say we are able to increase this income to $15,000. We're able to increase the income to $15,000, but the market cap rate, so the going rate of cap rates in your market is still, let's say, just 10%. Now, you're getting a 15% cap rate maybe because of the improvements that you've made. You could also decrease the operating expenses. If you could find a way to make the operating expenses more efficient, the dollar go farther with your operating expenses, that's also going to increase your net operating income. So if we do these things, and we still only paid $100,000 for this property, but now we've got $15,000 coming in, and the cap rate, the market cap rate, the normal going rate, if there's an investor looking to buy an investment property, if they should expect a 10% rate, and a 10% rate is a good rate of return for the area, we don't have to sell this with a 15% rate of return. So now our third question is, okay, what is the value on this property if we're getting $15,000 of income and our cap rate is going to be just 10%? Now we know with a 15% cap rate, the value is still $100,000. But if 10% is a competitive cap rate, meaning that there's other properties on the market, this is much more like the price when investors are looking at investment property. Yes, the dollar amount sometimes does have some bearing of the overall actual price of the property, but this is the term that they're usually most concerned with, of how much rate of return is it that they're going to get. A property could be worth $1 million, but if the rate of return is only 5%, a $100,000 property with a 10% rate of return is a better use of that money. Might require a little bit more management, so you could get a little bit deeper than that, but overall, that rate of return is better. Rather than buying $1 million property with a 5% rate of return, if you get 10 $100,000 properties with a 10% rate of return, you're getting a double rate of return than you would with that other investment. So that's why this is the more important number typically to investors, is the cap rate. The price is secondary to what that cap rate is, and that's why it's so important to know this. So looking for this third number, we're looking for the value. And we circle what we're looking for, the value. What we're left with is income over rate. Value is income over rate. So we're trying to find out what the value of this property is, what we could sell this for if we've got $15,000 worth of income, and we've got a 10% cap rate. And if we do that math, that property now has a value of $150,000. So what did we just do there? We created $5,000 worth of income. That's all we had to do. We just had to make $5,000 in the year, and now when we go to sell that property, if the same cap rate still prevails, we're looking at a $50,000 profit. Not factoring in cost and whatnot. Again, this is just the surface level simple side of this here. But before we get any deeper, you've got to have a firm understanding of the cap rate. And that's how powerful the cap rate is. If we're getting a 15% rate of return, if this is what we need to be competitive in the market, then yeah, we could only sell that property still for $100,000, and really we overpaid for a 10% cap rate on this. So let's say going into this here, if we want to buy this, using another example here, if we want to buy this property for $100,000, this property that's advertised for $100,000, that's got a $10,000 income, but we don't want a 10% rate of return, 10% rate of return, we want a 15% rate of return. So we went about that one way, saying, okay, well, what does our income need to be if we want a 15% rate of return and we pay $100,000? But now the question, again, going back to value, what should we pay for the property? What's the true value of this property if we want a 15% cap rate instead of a 10% cap rate? So going into this property, again, if we're looking at it at $10,000 worth of income currently, this is before we increase it up to $15,000. If we divide this now by 0.15, it's going to be like 85,000, somewhere in that range there. So 10,000 divided by 0.15. Oh no, I was way off. $66,000. Just round it right there. Again, that's how powerful the cap rate is. With $10,000 worth of income at a 10% cap rate, that's $100,000 that property is worth. If we're taking that same income and putting it at a 15% cap rate, that property is worth $66,667. But now, again, going back to this here, if 15% is the prevailing rate in the market, if that's a going cap rate, if that's what investors expect, if that's what investors are looking for, then we have to find the value using what investors are looking for in a cap rate. Because if we're offering a 10% cap rate, but there's another property offering a 15% cap rate, they'll take that 15% cap rate. And this again is based on net operating income after expenses. So this is assuming that all the expenses are already factored in. The only expense that wouldn't normally be factored into this is mortgage financing. So what type of financing you're using. But aside from that, everything else is included there. So we're going to take a quick commercial break, but when we come back, we're going to dive deeper into cap rate, go deeper into one of these examples here of kind of using these same numbers, but we're going to use a little bit bigger numbers. So stick with us. I'm John Chrismo. You're watching Ask the Instructor. If you've been thinking about real estate, look, in this current market, it's hard not to. There's so many opportunities that exist out there for residential real estate, commercial real estate, business brokerage, property management. I mean, it's ridiculous how much opportunity lies from having a real estate license. So look, if you've been thinking about getting a real estate license, I mean, it's minimal cost compared to starting other careers and starting other businesses to get into this. So I urge you to check it out and give it a try. I mean, even if you're just using your license for personal use, you've got huge, immense benefits there. Go to this link. It's licensefl.com. That's licensefl.com. Put that link in the description. It's got your step-by-step guide to get a Florida real estate license. And look, check it out. Give us a call. We're here to answer any questions it is that you have, and go out there and make some money.
Does your current career allow for unlimited income potential? With a career in real estate, the sky is the limit. What you put in is what you get out. Find out more about how you can tap into the unlimited income potential of a career in real estate at tampaschool.com. Did you know that statewide only about 50% of test takers pass their state exam on the first try? At the Tampa School of Real Estate, we've broken down passing class and state exams into 4 simple steps: learning the information, reinforcing the information, testing your knowledge, and being confident and prepared. View the details of the full strategy at passfirsttry.com. That's passfirsttry.com.
Hey, if you're enjoying the show today, which I'm sure you are, be sure to hit like, subscribe, post your comments, share with your friends and family. Thank you guys so much for watching. Hey, welcome back to this week's episode of Ask the Instructor. I'm John Chrismo. The show is brought to you by the Tampa School of Real Estate every Wednesday at 12 noon Eastern Time. We're live, helping you understand the technical side of the real estate industry. And what we're talking about today is cap rate. And we already went through, before we took the break, and went through the Irv Triangle, the IRV Triangle, which the way that works, you've got income, rate, and value, income, rate, and value, IRV, income, rate, and value. You lay it out like this with a little multiplication symbol down there in the bottom, and you circle what you're looking for, and what's left over is your formula. So when we're looking for rate, we circle rate, we're left with income over value. When we're looking for value, that's income divided by rate. When we're looking for income, that's rate times value. And that's the basics of knowing how to, this is like your multiplication and division and addition and subtraction for investment property, for income producing investment property. If you don't know how to do this, if you don't even know how to add or subtract, you're not going to be able to do calculus. You're not going to be able to understand investment property until you've got this cap rate stuff down. And not just down, but memorized. You know, if you still need to draw out this IRV triangle, that's what it's there for, to make sure you don't forget about this. Maybe you don't even have the triangle in. You just draw I over R times V. Doesn't even have to be in a triangle. No problem not doing it in a triangle. Just remember it's I over R times V. That's your formula really for this year. I don't know when the triangle got added into it, but it does make it a little bit more memorable. So let's go through another example here. In this example we're going to go through, we're going to be investors. We're investors that are purchasing a property. And what our goal is to buy the property at a certain price. And this is an income producing property, a property that's already cash flowing with rental properties. So let's say it's a 10-unit building. So we're looking at buying this 10-unit building. And each of these units are currently renting for, let's say, about $2,000 a month. So looking at this property where we've got 10 units renting out for $2,000 a month, let's just first start off with figuring out how much money we've got coming in a month. We've got 10 units times $2,000, which means we've got $20,000 a month. That's our gross rent for the month, if it's 100% rented, which we'll get to that in a second. And now what we're going to do is convert this to an annual number, because everything we want to work with, we want it in terms of annual numbers. So we'll go ahead and just multiply this by 12. I think that's 240,000. Yeah, $240,000. Always trust your calculator. So we call this $240,000 potential gross income. This is the potential that this property can gross in a year. If we could realistically rent these for $2,000 a month each, maybe most of them are already rented for $2,000 a month. So if we could realistically rent these all for $2,000 a month each, that would get us $20,000 a month or $240,000 a year in potential gross income. So that's what it's going to be if we have this 100% rented. But now the problem is it won't be 100% rented. Maybe we get lucky, and we do. That's why we do this calculation of potential gross income. So we know, hey, if we really push the envelope and really make sure this is rented 100% of the time, but not only rented 100% of the time, but everyone pays the rent on time as well. If we really get to that perfect world, that's our top limit. That's our top number. We're not going to exceed that. But we've got to factor in for vacancy and collection losses. So if we assume that there's 10% vacancy and collection losses, 10% of $240,000 is $24,000. So we subtract out that $24,000. So again, what we've gone through and done here is we started with the potential gross income of $240,000. That's if everything rents for $2,000 a month, 10 units. But factoring in 10% of our money being lost, or really never collected, because we never collect this money from vacancy, or if they're not paying their rent. So when we take the potential gross income and subtract that $24,000 that we never see, we're left with $216,000. And that $216,000 is what we call our effective gross income, our EGI. So that's how much effectively is grossed by this property when we factor out vacancy and collection losses. So we assumed, again, that 10% of the time, we're not getting rent. We're not collecting that $2,000 10% of the time. So put that across a year, and that's $216,000 that we really have coming in. But now we also need to figure in our operating expenses. So we need to figure in our operating expenses, which we'll just pick a nice easy number with this here. Now, ideally in the real world, if you're looking at this investment property, you're going off of the numbers it is that they're already giving you. It's extremely risky if you're considering constructing a property like this without the appropriate experience, without knowing what works in this particular market, or buying a vacant property, a 10-unit building that's empty. Why is it empty? Why is there no one living there? Why is there no income? So that's extremely risky, and only for the most experienced investors, if you're doing something like that, can be very lucrative, much higher returns probably with something like that rather than just buying something that's already operating, because this is already tried and true and proven. But let's say this property currently operates with $100,000 in operating expenses. So we take our effective gross income of $216,000, and let's make it a nice even $100,000 that we're going to have of net operating income. Your numbers, you won't have the ability to just make them nicer looking. But let's say our operating expenses, the expenses to operate the property, which is basically everything related to the operation of the property. The only expense that's usually that we wouldn't include in here is financing. So any mortgages or financing expenses we would not include. So if we take out our $116,000 in operating expenses, we're left with a net operating income of $100,000. Isn't that nice how that all worked out to a nice even number like that? Sometimes they do, but when you get numbers that end in zeros like that, those are not trustworthy numbers, because numbers shouldn't always just end in zeros like that. But for example purposes, as we work through this, it's fine here. So if this property has a net operating income of $100,000, that's the income that we're using for the IRV triangle. So again, we pull up our IRV triangle, I over R times V. And let's say that the seller, this is the seller doing this and saying, okay, well, what's my value of this property? Well, the value is income over rate. So our value on this property is going to be the $100,000 net operating income divided by the capitalization rate. And now if you're thinking about selling this property, if you're the seller of this property, you've got to look at what cap rates are in the area. This is kind of like what you're doing almost sales comparison wise, except for this is where you're just trying to be competitive. You know, if you're trying to sell this property with a 2% cap rate, if 2% is common in the market, maybe that's a great deal. But if 10% is the common cap rate in your market, why would they want to take on a 2% return on investment when they could easily get a 10% return on investment instead? So you got to look at your market and what the going rate is for cap rates in your market so you can be competitive when you're selling this property. But let's just assume, again, we'll use our 10% cap rate, which for the Tampa area, it's a little high. That's a little bit higher than what it typically is here. But other markets, that might be a low cap rate. It depends. It depends on your market. It depends on how competitive the rental space is. So when we divide that out, $100,000 divided by 10%, we get a cap rate, or a value, of $1 million. So we're looking at buying this property for $1 million. That's what it's listed for sale. And what we're going to do is say, okay, well, if I do pay the $1 million, how can I not only get cash flow, get this $100,000 of net operating income a year, which works out to just slightly under $10,000 a month. So how can I not only get that, but then on top of that, also be able to sell this property for a higher price? How do you flip an income-producing property? What you're flipping is the numbers. So this is where can be immense opportunity for a mismanaged property that has rents that are too low. So let's say that we go in here, new landlords in town. Now we've got to honor the existing leases and whatnot. But let's say that we're going to bump the rents from $2,000 to $2,500. Let's say we look at this here and we say, all right, yeah, we're going to bump the rents to $2,500. So we'll start all of our math all over again here. With $2,500 times 10 times 12 times 10 units times 12 months. And now our potential gross unit, and why we'd be doing this, going into this apartment community saying, hey, we're increasing the rents, is because the rent's being significantly undervalued. And if we know that we can pull in $2,500 tenants, we might even get some of these to stay with that new higher rent of $2,500. Maybe we do this over a period of 2 years. Maybe we spread this out. Maybe 1 year we bump it $250 and the next year we bump it $250 again. But just to keep things a little bit simpler here, you could again elaborate this out much further in the real world. But let's just go off of this here. So 2,500 times 10 times 12. Now we're pulling in potential gross income of $300,000. So now we've got potential gross income of $300,000. Now we still have to take out our vacancy and collection losses, which if we keep that same 10% rate, then we're losing $30,000, or we're never collecting that $30,000. But especially if we're going through a bump this high, let's factor in for having higher vacancy and collection losses, because if we're going in there and bumping all the rents by $500 at the end of everyone's leases, we're going to get some turnover in there. So we've got to account for that. And again, that's maybe where if you say, all right, well, let's do a 250, then a 250. It depends on what your long-term goals are, because if you're doing that smaller bump as opposed to one large bump, and these aren't scientific measures for all this here, but as a general rule, 2 smaller bumps will have a lower turnover rate than 1 large bump. So if we spread that out, maybe that helps out a little bit. But let's go ahead and just go in here and say that, hey, we're probably going to have a 15% vacancy and collection loss rather than just the 10% that is currently operating under, because we will be going through some turnover and we'll get that corrected going into the next few years. Maybe you want to get that sorted out right up front. Maybe go right in and do the bump of the $500, and then the next year you're able to bring that back down to a 10% vacancy and collection loss. So maybe you do that, because if you're planning on selling this property and flipping it, they might be a little uneasy if they see a 15% vacancy and collection loss as opposed to other properties that have a 10% vacancy and collection loss. So at a 15% vacancy and collection loss, that would be $45,000 that we're losing on this property. So that brings us down to $255,000 of effective gross income. So even with, though, that higher vacancy and collection losses, even with losing an additional 5% of the rent a year, we're still coming out on top, because before we were at $216,000, now we're way up here at $255,000. But let's say on top of that, we're also able to reduce the expenses a little bit. We're reducing the operating expenses. Maybe we see some vast inefficiencies in the way the property is operated. So we're able to decrease this maybe from $116,000 to, let's just bring it down to, we'll say $105,000. So we bump down the operating expenses by about $11,000. So let's say our operating expenses now end up being $105,000. Now our net operating income is $150,000, which is a much more significant net operating income than just the $100,000. So now with this higher net operating income of $150,000, again, if we're trying to find, okay, what is the value on this property if our net operating income is $150,000 and we're still having that 10% cap rate, well, now our value has become $1.5 million. So maybe we're doing this over the period of 2 years. Over the period of 2 years, we're going in there, we're raising the rents, we're decreasing operating expenses. Not only are we going to collect $100,000 maybe that first year, and then maybe $150,000 the second year, but then on top of that, we're collecting, and of course there's going to be costs associated with the sale, brokerage commissions, closing costs, things like that. But overall, just on the flip alone, going from $1 million that we bought it for and being able now to sell it and command a price of $1.5 million, that's $500,000 there, $600,000, $750,000. So say this is year 1 and then that's year 2. So over the course of 2 years, we're making $750,000, which you would think that you might not be able to get a 75, or we'll really split that across 2 years, but we'll say across 2 years. Over 2 years to almost double your money, because we put $1 million in. And 2 years later with this math, and this is just a theoretical scenario, but this just helps open your eyes to what's possible. You might not be able to double your money in 2 years. Maybe it takes 5 years to accomplish this. But hey, doubling your money in 10 years investment-wise is a really strong investment. So you've got to be able to work these numbers, because this is how you make sense of this. This is how you come up with your plan for what it is that you're doing with this investment property. Do you want to just sit on it and collect $100,000? You know, that's good too. In 10 years, you would double your money. That's kind of what we're doing here with this 10% cap rate. 10 years, we would have double our money with everything being the same, without raising rents, without increasing the operating expenses. So that's 10 years to double the money just off of the rent it is that we're collecting. Any of this other stuff that we're doing, this manipulation of the financials by increasing the rents, by decreasing operating expenses, by generating additional income in the property. Maybe there's garage units, and people have just been using these garage units for free. Maybe you're charging now for these garage units or these storage units or whatever the case may be. Maybe there's so many ways it is that you could generate more income. And at a maximum in this situation, 10 years, you will have doubled your money. So that's the maximum amount of time. And that's if you don't do anything. But anyway, you're able to increase the rent. Anyway, you're able to decrease operating expenses. That's shortening the time it's going to take to double your money. From 10 years, maybe down to 5 years, maybe down to 2 years like we did with this example right here. Who knows, maybe you'd even do this in 1 year. That's going to be a really big if, but it's absolutely possible if you find the right opportunity. The right opportunity, the right know-how, and the right action, this is all possible. So that's about all the time it is that we've got for today, talking about cap rate. We have done episodes on this before, so if you want to get deeper into this and go through more calculations and whatnot of cap rate and investment value and so on and so forth, check out our Success Center, tampaschool.com/success. You'll be able to watch the full replay of today's show on there. That's tampaschool.com/success. If you've got any questions about obtaining your real estate license, or maybe you need to do post-licensing or continuing education or anything like that, and maybe study for your exam, give us a call. The phone number is 813-333-2676. Again, that's 813-333-2676. Again, that's about all the time we've got for today. Check out our website, tampaschool.com. Thank you guys for tuning in. I'll see you Friday for State of Real Estate. Hey, so if you're thinking about starting a real estate career, it could feel a little overwhelming sometimes. Look, that's completely understandable. That's why we're here to help. If you haven't already, check out our Success Center, tampaschool.com/success. Or if you don't even know where to begin, give us a call. We'd love to help you out. We've got advisors standing by to answer any questions you have and assist you in any way it is that we can. Our phone number is 813-928-0106. Again, that's 813-928-0106. Give us a call. We're the Tampa School of Real Estate.
Do you want a career that allows you to be in control? With a career in real estate, you'll get to call the shots. Whether you're looking at starting part-time or want to become the next top agent, a career in real estate makes it possible. Find out what it takes at tampaschool.com. Do you want to incorporate studying for your real estate exams into your busy schedule? Now you can review the key topics you need to know to pass your class and state exams with our MP3 audio review. Simply pop in your headphones or connect to your car to reinforce crucial information while you exercise or drive. Listen to the first unit for free at mp3audioreview.com. That's mp3audioreview.com.
Are you thinking about a career in real estate? Hey, I'm John Chrisma with the Tampa School of Real Estate, and we've helped thousands of people just like you obtain their real estate license. If you're thinking about a career in real estate, give us a call. The phone number is 813-928-0106. Our advisors are standing by to answer any questions you have and assist you in any way they can. Hey, if you're enjoying the show today, which I'm sure you are, be sure to hit like, subscribe, post your comments, share with your friends and family. Thank you guys so much for watching.